ever get a craving for KFC, but not in, like, the U.S., like, say, Nepal.
Interesting.
Or maybe you're really feeling Pizza Hut, but you're in Nigeria.
Okay, I see where you're going with this.
Today, we're going deep on a company making those cravings very real. Devyani International Ltd, or DIL.
Ah, DIL, a major player in the quick service restaurant scene.
Giant, even, and not just in India anymore.
Right, expanding their reach.
We'll cover their history, how they fit into this fast-changing market, financials, and, get this, a surprise move into Thailand.
Sounds like we've got a lot to unpack.
We do. Luckily, we've got our expert here to help us make sense of it all, ready to dive in.
Absolutely. DIL's story is, well, fascinating. Growth, adaptation, the whole package.
So, listeners, before we get into the numbers and all that, let's set the scene. Imagine you're in India,
Okay, I'm picturing it.
and you're hit with a craving for, I don't know, a bucket of KFC.
Classic.
Or you're in Nepal, and it's Pizza Hut calling your name.
Chances are you'd be experiencing the world of DIL. Their brand portfolio is impressive.
Beyond those two, they also run Costa Coffee in India.
Right, and they haven't stopped there, as you mentioned. They've got their sights set on international expansion, Nigeria, and of course, Thailand.
That Thai connection, we'll get into that later, it's a good one, showing just how ambitious they are, becoming a global QSR player.
Ambition backed by experience. Their relationship with Yum Brands goes way back.
Tell me about it.
It all started in 1997. Pizza Hut franchises in India. Later on, they added KFC to the mix, and, well, they haven't looked back.
From 12,243 stores in 2023 to 1,782 by March 2024. That includes their Thailand expansion, which, like I said, we'll get to. But first, let's zoom out.
Okay, broader perspective.
What's the Indian QSR market looking like these days?
It's booming, no other way to put it. Estimated at $25 billion in 2024 and projected to hit almost $40 billion by 2029. That's a compound annual growth rate of 8.7%.
8.7%. Wow. Okay. What's fueling that? Just India's overall growth, or is there something more specific at play?
It's a combination of factors. Rapid urbanization plays a big role. People move to cities, and eating out becomes the norm. Plus, rising disposable incomes, especially among younger folks, make those chained outlets, the ones DIL operates, super attractive.
Makes sense. Didn't chained outlets already represent a significant chunk of the market in 2023?
Yeah, they held a 52% share. And get this, meat-based cuisines are huge in India. Good news for KFC.
Definitely plays to their strengths. What about Pizza Hut? Are they holding their own?
Pizzas is actually exploding in popularity, projected growth rate of 11% annually between 2024 and 2029. Pizza Hut is in a prime position to capitalize on that.
So we've got this hot market, and DIL's right there with some power brands. But the real question is, how are they performing within all this?
Right. Translating market growth into their own success, that's the key. Let's start with revenue growth. Are they seeing the results?
Let's get specific. I'm curious about same-store sales growth, that SSSG. Tells us how well existing stores are doing, right? Break it down for us. How are KFC, Pizza Hut, and Costa Coffee each performing?
Each brand has its own story. Let's start with KFC India.
Okay, KFC, let's hear it.
They've seen a jump from 490 stores in 2023 to 596 in 2024. Impressive on its own, but the same-store sales growth tells an even more interesting story.
Ooh, suspense building.
Let's not get ahead of ourselves. Before we dive into those numbers, let's look at the bigger picture of DIL's brand expansion.
Okay, keep us on our toes. So Pizza Hut next.
Yep. Pizza Hut India expanded a bit slower, from 506 stores in 2023 to 567 in 2024. But remember, they're already tapping into a market that loves pizza.
What about Costa Coffee? Keeping up with the big guys.
That's where things get really interesting. Costa Coffee actually shows the most significant growth, going from 112 stores in 2023 to a whopping 179 in 2024. Big jump.
Wow, they're not messing around. DIL's on a roll across all their brands. But growth is just one piece of the puzzle.
You got it. We need to look at how well they're managing costs, optimizing their operations, driving profitability. That's what shows long-term success.
Let's talk profit margins and financial health. What should we be paying attention to?
A few key metrics give us a good picture of DIL's financial performance. We'll start with EBITDA margins. That's earnings before interest, taxes, depreciation, and amortization.
EBITDA, got it. A bit technical for those of us who aren't finance whizzes. Why is it important?
Think of it this way. EBITDA helps us understand the core profitability of their operations, taking away things like financing costs and accounting quirks. It shows how efficiently they're running the business, generating cash from their core activities.
Okay, starting to see why that matters. So, what are Delisle's EBITDA margins telling us?
We'll get to the specifics in a bit, but first, another key metric, profit after tax, or PAT.
Pat, that one rings a bell. Isn't that essentially the bottom line, the actual profit after all the expenses are paid?
Exactly. PAT shows how much money they're making after all the bills are settled. When we look at DIL's PAT trends, we get insights into their cost control measures.
Cost control, always a good story. What kind of initiatives have they implemented?
They've been very strategic. They've focused on optimizing menu pricing, finding that sweet spot between affordability for customers and maximizing their profit margins.
Makes sense. You can't just keep raising prices without considering the impact on demand. So what else are they doing?
They're big on waste reduction, which is a win-win, right? Reduces costs and minimizes environmental impact.
Sustainable savings. Love it. Anything else they're doing to keep those costs in check?
Tighter cost controls across the board, everything from negotiating better deals with suppliers to streamlining their supply chain, optimizing staffing levels, even energy-saving measures in their stores.
Sounds like they're running a tight ship.
Absolutely. And their financial performance reflects that. But before we dive into their financial health, let's rewind a bit. Back to their expansion strategy.
Ah, yes, that massive growth spurt. We know they're adding stores left and right. But where's the focus? Major cities or venturing out?
Their strategy is quite clever. They're putting a lot of emphasis on non-metro areas in India. 51% of their stores are located outside major metropolitan cities.
So tapping into the heartland where there's a lot of untapped potential.
Exactly. They see that the non-metro economy is booming, rising incomes, growing appetite for QSR brands. They're getting in early, capturing a customer base that's eager for what they offer.
Planting seeds in fertile ground. But what about that international expansion? We keep teasing this Thailand move. What's the story there?
Okay, here's the twist. They acquired a controlling stake in Restaurants Development Company, Ltd, or RD, in Thailand. And guess what? RD is a major KFC franchisee, already operating 288 outlets as of March 2024.
So they basically became a KFC powerhouse in Thailand overnight.
Pretty much. But it's not random. There's a strategic rationale behind this acquisition.
I'm all ears. What makes Thailand such an attractive market for DIL?
Several reasons. First, Thailand has a strong poultry market, essential for a brand like KFC. Chicken supply secured.
Chicken is king for KFC, so that makes sense. But anything else that makes Thailand a good fit for DIL's ambitions?
Thailand is a high middle-income nation, strong consumption levels. There's a healthy demand for QSR brands.
So DIL is entering a market ready for what they do best.
Right. And this acquisition opens up even more possibilities. They're exploring introducing their other brands, like Pizza Hut and Costa Coffee, into the Thai market.
I like where this is going. Long-term vision. But before we get ahead of ourselves and dream of Pizza Huts on the beaches of Phuket, let's come back to the present.
Back to reality.
We've talked about expansion, domestic and international, but there's another crucial piece of the modern QSR puzzle. Digital.
Absolutely. Can't forget about the digital world.
Online ordering and delivery are huge these days. How's DIL approaching this? Are they embracing the trend?
They're more than embracing it. They're shaping it. They've developed what they call an omni-channel strategy, creating a seamless experience for customers, whether they dine in, take away, or order delivery.
Sounds ambitious. What are they actually doing to make that happen?
Investing heavily in online ordering platforms, streamlining delivery operations, making online ordering easy, intuitive, and optimizing their delivery network for speed and reliability.
Smart move. Smooth and timely delivery makes all the difference. Speaking of delivery versus dine-in, what's the split for their brands? How much business is coming from each channel?
It varies by brand. For KFC India, 61% is on-premise consumption, so dine-in and takeaway. The remaining 39% is off-premise, mainly delivery.
So in India, KFC still sees a majority of its customers choosing the traditional in-store experience. What about Pizza Hut?
It's the opposite for Pizza Hut India. 44% is on-premise, while 56% is off-premise, primarily delivery.
Interesting. Pizza's more of a delivery thing in India, it seems. How are they adapting their strategy to accommodate that?
They're being very strategic, recognizing that a one-size-fits-all approach doesn't work in the digital age. And this has led to an interesting development in their Pizza Hut business. They're shifting towards smaller, delivery-focused units.
Smaller stores? That seems counterintuitive. Wouldn't they need more space for handling all those delivery orders?
You'd think so, but it's actually a savvy move. By focusing on smaller units designed specifically for delivery, they can streamline operations, reduce overhead costs, and improve their unit-level metrics.
Okay, I see the logic. Efficiency and speed in the delivery game.
Exactly. Smaller units mean they can get closer to their delivery customers, minimize delivery times, and improve the overall experience. Plus, it allows for faster expansion, lower setup costs, so they can reach more neighborhoods, capture more of the delivery market.
It's like they're playing chess, positioning themselves for maximum impact. So where does DIL stand in the overall Indian QSR market with all these moves?
They're undoubtedly among the top players, a force to be reckoned with, but what sets them apart?
I'm all ears. What are their secret weapons?
First, they have a diverse brand portfolio, catering to a wide range of tastes. KFC, Pizza Hut, Costa Coffee, each has its own appeal, allowing them to capture different market segments.
Covering all the bases, from fried chicken to coffee. But anything else giving them a competitive edge?
Their focus on non-metro areas is a big one. While many competitors are clustered in major cities, DIL is tapping into that booming non-metro market, less competition, strong foothold.
Winning on geography.
Anything else? Their commitment to innovation is key. They're not complacent. They're constantly evolving, adapting to the market. New menu items, creative marketing campaigns, embracing new technologies, always staying ahead of the curve.
Essential in a fast-paced industry. And we can't forget their omni-channel approach. Seamless experience across all channels, a big draw for customers.
Absolutely. They're making it convenient and enjoyable for customers to engage with their brands however they choose to do it.
Removing friction points, creating a smooth experience. But beyond the business basics, anything else that stands out about DIL?
Their commitment to social responsibility. They're not just about profits, they're actively giving back. Initiatives like women-led stores, empowering women entrepreneurs, and their involvement in the Feed the Children program, addressing food insecurity.
Impressive. Walking the walk when it comes to social responsibility.
Definitely. And it resonates with consumers, especially younger generations, who care about a company's values.
All right, we've covered a lot. Growth, acquisitions, innovations, social responsibility. But we can't wrap up without addressing the elephant in the room, their financial health.
Right. We need to look at their financial stability and potential risks. That's what ultimately determines their ability to keep growing and achieve their goals.
So let's dive into the numbers. What are the key financial indicators?
We need to consider their debt levels, cash flow, and liquidity trends. These give us insights into their ability to meet their financial obligations, handle economic challenges, and ensure long-term sustainability.
Okay, let's start with debt. How much debt does DIL have, and should we be worried?
Their debt levels have been increasing, partly due to their expansion strategy, which often involves taking on debt to finance new stores and acquisitions.
Growth can be expensive, but is their debt manageable, or is it a red flag?
It's manageable for now, but definitely something to keep an eye on, especially as interest rates rise. The cost of servicing that debt could become a burden on their profitability.
A balancing act, managing their debt carefully to sustain growth without jeopardizing their financial stability. What about their cash flow? Is it healthy enough to support their plans?
They've shown strong cash flow. Their operations are generating healthy cash, and they have access to financing for investments. This gives them a solid foundation for continued expansion.
Good news. What about their liquidity? Can they meet their short-term obligations without issues?
Their liquidity is healthy. They have enough cash on hand and readily available assets to cover their short-term liabilities. This suggests they're in a good position to handle unexpected expenses or economic fluctuations.
So overall, it sounds like DIL is in a solid financial position, but those rising debt levels are worth watching.
Exactly. Strong foundation, but it's important to monitor their financial performance and make sure they're managing debt prudently. Yeah, it's impressive how they've managed to grow like that while keeping that focus on social responsibility. It really shows they're in it for the long haul, building a business that benefits everyone, shareholders, employees, customers, the whole community.
No doubt.
Yeah.
It's not just about the bottom line anymore. People are demanding more, and DIL seems to get that. But let's be real. Every company faces challenges, even the successful ones.
True. Even a market as hot as India's QSR sector has its bumps in the road. And DIL might be hitting a few of those bumps soon.
Okay, let's not sugarcoat it. What potential problems are they facing?
Well, that debt load we talked about, that's something they'll need to handle carefully. It's manageable now, but with interest rates going up, it could start eating into their profits.
A delicate balancing act, growing without taking on too much risk. Anything else on your radar?
Keeping those profits up with rising input costs, that's a big challenge. Food prices especially, they can jump around and that squeezes margins. They've been good at controlling costs so far, but it's a constant battle.
Every penny counts when you're operating at that scale. And don't forget, they're expanding internationally, which adds another layer of complexity.
Yeah, managing a global operation, adapting to different markets, that's not easy. Every country has its own quirks, economic conditions, regulations, what customers want.
So they need to be adaptable, flexible, like a chameleon. Can't just copy-paste their India success story. They need to tailor it to each market.
Exactly. And they can't ignore the competition. The QSR space is crowded, new players popping up all the time. DIL needs to keep innovating, improving customer experience, building their brand to stay ahead.
Okay, challenges noted. But let's not get too gloomy. What are some of DIL's big opportunities? Where could they really shine?
That Thailand move, that's a huge opportunity. Like we said, it's a growing market, strong QSR sector. If they can leverage their experience, bring in those other brands, Pizza Hut, Costa Coffee, it could really take off for them.
So they've got that KFC foundation. Now it's about expanding, capturing more of that Thai market share. What other opportunities are you seeing?
International expansion, for sure. They've shown they can succeed outside India, so why not take that model to other parts of the world? Southeast Asia, Africa, maybe even Latin America. Choosing markets where their brands and expertise would really resonate.
Global QSR empire. Sounds ambitious. But what about closer to home? Any opportunities in their existing markets?
Definitely. Their digital capabilities, that's a huge area for growth. They're already doing well with the omni-channel strategy, but they could take it even further. Personalization, loyalty programs, data analytics, all those things can enhance customer experience and drive engagement.
Personalized offers, loyalty rewards. Sign me up.
Mhm.
What else in the digital realm?
New technologies, like AI, that's a game changer. Imagine AI-powered chatbots for customer service, algorithms optimizing delivery routes, even AI-driven menu recommendations based on what you like.
AI pizza recommendations. That's getting futuristic. But seriously, DIL seems ready to ride that digital wave.
They are, and their commitment to social responsibility, that's another advantage. Consumers care about a company's values, and DIL's initiatives, things like women empowerment and fighting food insecurity, that gives them an edge.
Doing good is good business, especially these days.
Absolutely. And it's not just about attracting customers, it's about building a strong brand, attracting talent, making a real difference.
We've covered a lot today. History, market position, financials, challenges, opportunities, a full picture of DIL. But now, over to you, the listener.
Time for you to take all this information and form your own conclusions.
What are your takeaways from this deep dive?
Are you as optimistic about DIL's future as we are?
Do you share any of our concerns about their financials?
Maybe you see something we missed, a hidden opportunity, or a potential risk.
Share your thoughts, questions, perspectives. The more viewpoints we have, the richer the discussion.
Let's hear it. What do you think about DIL?
Would you invest in this company?
Would you recommend it to a friend?
We're curious to know your take. It's always great to hear different perspectives, get those insights. Whether you're a seasoned investor or just someone who enjoys a good fried chicken now and then, tell us what you think about DIL.
Exactly. That's what these deep dives are all about. Getting those conversations going, making us think critically about the businesses, the food we eat, even our investment decisions.
Right on. We're not telling you what to think, but we want to give you the info, the tools to form your own opinions.
So as we wrap up our look at Devyani International Ltd, let's summarize a few key takeaways.
First things first, DIL. They're on the move, constantly pushing forward.
They're not just content with their success in India, they're looking beyond, expanding domestically and internationally.
That growth strategy, it's clear to see store expansion, acquisitions, ambitious plans for new markets like Thailand.
They're not afraid to take risks, to, push the envelope. But like with any big move, there are risks.
Those rising debt levels, we talked about that. It's manageable now, but it's something to watch. Make sure they're not getting in over their heads.
Right. That balance between growth and being financially responsible, it's tricky. But beyond the numbers, there's a lot to admire about how they do business.
Their commitment to innovation, it's impressive. The menu, their digital strategy, they're always looking for ways to improve.
That omni-channel strategy, it really shows their forward-thinking approach. Creating a seamless experience, whether you dine in, order online, get it delivered, it's all about the customer.
And we can't forget their commitment to social responsibility. Women empowerment, food security, they're showing that they care about more than just profits.
It's refreshing, honestly. A company that gets it, doing good is good for business. Long-term success, it's about more than just the numbers.
Well said. So, as you go about your day, maybe you grab some KFC or enjoy a Pizza Hut meal, think about the company behind it, that story of growth, ambition, and, responsibility.
And remember, investing, it's a journey. Do your research, stay informed, make smart decisions that align with your values and your financial goals.
Couldn't have said it better myself.
Yeah.
That's it for today's deep dive. Thanks for joining us. And until next time, happy investing.